Welcome, everyone. I'm Chris Clow, editor for HW Media and Reverse Mortgage Daily, sitting in today for Sarah Wheeler. Today on HousingWire Daily, we sat down with HW Media managing editor James Kleimann to talk about a recent enforcement action by the CFPB against a mortgage lender and how the average independent mortgage bank lost $534 per loan in the second quarter, marking a big improvement over Q1. But first, here's a word from our sponsor.
Hi, I'm Sarah Wheeler, editor-in-chief at HW Media, talking to Desmond Smith, Chief Growth Officer at UWM, about SafeCheck. Desmond, how does SafeCheck work?
Hey, Sarah, how are you? So I would say first, SafeCheck is allowing LOs to give their borrowers peace of mind. So I'd start there. Trigger leads have become a very large issue, not just in the mortgage space, but in any time someone's getting any type of credit. So we created SafeCheck to help prevent kind of that aggravation and nuance of receiving, tens, 20s, hundreds of calls that consumers receive. So what happens with SafeCheck is any LO who uses UWM, it's an exclusive product, SafeCheck is to UWM, they would be able to either pull a single or a tri-merge soft pull credit report. And while that credit report is being used to run AUS, they will have time to opt their consumer out of any solicitations, and then therefore they will not receive all of those annoying calls and annoying solicitations. And that is also a big benefit because the cost of the credit bureau is much cheaper by leveraging SafeCheck. So it really is a win for LOs, and it's obviously a win for consumers so they don't receive so many phone calls offering all different types of products and services.
I can see how that could be a game changer. Thanks, Desmond. And listeners, you can find out more at uwm.com.
James, welcome back to HousingWire Daily. We appreciate you making the time.
Hey, thanks for having me, Chris.
Oh, of course. Much obliged. Well, first off, we should talk about the recent decision by the Consumer Financial Protection Bureau, or CFPB, to fine Freedom Mortgage Corporation and Realty Connect USA Long Island for illegal kickbacks. What can you tell me about it?
Yeah, this is a big one. I think this has been a little under the radar as well. This represents the first enforcement action associated with the 1974 Real Estate Settlement Procedures Act, better known as RESPA, in 6 years. So the CFPB hasn't come down on a company over RESPA violations since 2017. And I think that's pretty major. It's such a gray area. And the fact that the CFPB has really made a big statement in going after a lender that, by the way, is a top 25 lender and has been among the biggest lenders in America for quite some time. I think it's pretty significant. And the allegations are very serious. So, Rohit Chopra, the director of the CFPB, he said that Freedom provided kickbacks to real estate brokers and agents, including those at Realty Connect, in return for mortgage referrals. And that's a clear violation of federal law. And the CFPB is going to continue to try to root out what they believe is anti-competitive behavior. And that's something that we've seen a lot of in general from the Biden administration. The FTC has been pretty serious trying to shut down mergers and acquisitions that they deem anti-competitive. They took a run at the ICE Black Knight deal, I think fairly unsuccessfully, although they were able to exact a couple major concessions in Black Knight having to sell their LOS to get the deal across. And that deal does look poised to go through. So that they have made a lot of efforts in the last couple of years, really, to go after companies in the housing finance space and just general financing and say, look, if you're going to be maybe doing things a little bit too far into the dark gray area, we are going to, through enforcement action, say, here's where the line is. And anyone who does decide to cross it is going to get hit with a really big fine. I think the bigger question here, Chris, is because we've seen so few enforcement actions since 2017, we don't know, is this an anomaly? Is this just a very, specific case in which Freedom, it was looking for mortgage referrals through real estate brokerages and flew a little bit too close to the sun? Or is this more of a common practice that other mortgage lenders have been, doing similar, doing similar work and then finding that they just didn't get targeted for whatever reason. And Freedom is now the example, and everyone is on notice and is going to be changing the way they interact with these real estate brokerages. We don't know that yet. And the CFPB customarily does not really talk about these kinds of things. And Freedom, of course, has nothing to say on the matter, nor does the real estate brokerage, which, by the way, only had to pay a $200,000 fine. Freedom is paying a little bit closer to $1.8 million in fines, and those fines are going to be going to the CFPB's Victim Relief Fund. I think it will be hard to come up with very clear-cut victims of this. It's always tricky when you're looking at referral business and saying, okay, because this company decided to allegedly kick back this referral, that the customer got poor service or didn't receive, a deal that maybe they should have received, that they were taken advantage of and they lost thousands of dollars or even more potentially, right? So we don't really know the full extent of that. But the fact that the CFPB has publicized it so heavily and got a pretty big fine out of Freedom, I think suggests that they're going to be pretty serious about looking at this going forward. And if there are other companies engaging in similar practices, it's going to get shut down real quick.
Yeah, I noticed in the reporting, shout out to Brookley Hahn, by the way, for writing up the story. But yeah, you also mentioned it. This is the first RESPA enforcement action in 6 years. Why is this a tool used so sparingly in terms of enforcement practice? Or is it more just that there was a pretty big change up in the leadership of the federal government, so maybe they're more focused on something like this?
I think it's probably a little bit of both. So the CFPB hired a lot of attorneys in the last year and a half, 2 years, have really been kind of building up their enforcement division and have been pretty public in saying that they want to go after a lot of companies that are operating in this gray area. And these investigations typically take quite a long time. They don't just walk in to a mortgage lender's headquarters on Monday and come out with an order on Wednesday. They take several months to work through, and there are typically audits. There's all kinds of work that goes into it. I think partly there's a little bit more interest and dedicated resources on the part of the federal government, but also, like I said, these are tricky cases. These are not super common. It's I think rare that you see very obvious, very clear violations of RESPA. It's not normally so quid pro quo. It's not like, hey, how about this, Chris? If you get that client over to me, I'll give them a mortgage and I'll give you, 50 tickets to Seattle Mariners games, for the upcoming season. I mean, that would probably be pretty cruel as well, given how poor they are. But, it's usually not so obvious. What Freedom allegedly did here is basically, so the CFPB says Freedom enters into a marketing services agreement with a brokerage, and they're going to then pay the brokerage, X amount of dollars per month. And in this case, Freedom is alleged to have made such agreements with 40 different real estate brokerages, and the monthly payments that Freedom had sent cumulatively was about $90,000 a month. So it's real money. It's pretty significant. And instead of using these payments to compensate brokerages for the marketing services that they performed, Freedom used these marketing services agreements as a vehicle to pay for the mortgage referrals, right? A kickback. And so Realty Connect is one of those real estate brokerages, and they received about $6,000 a month from Freedom, but they didn't do a lot of the marketing tasks that the agreement should have required them to do. Now, there are other allegations as well related, right? So the CFPB says that Freedom offered real estate brokers and agents fee-free access to industry subscription services, which included information about property reports, comparable sales, and foreclosure data. And these perks were offered in exchange for a requirement that agents and brokers agree to be paired with a Freedom loan officer. So again, that's where the CFPB says there's nothing gray about that. That is quid pro quo. And Freedom also allegedly offered free access to parties and other exclusive events as well. And so, it kind of adds up if you believe the CFPB. And like I said, they just haven't really gone after cases like this. The last one in 2017 was a consent order with Prospect Mortgage based out of California. And they allegedly paid Remax, Gold Coast, and a Keller Williams affiliate monthly fees that were contingent on the number of referrals they gave to Prospect Mortgage. And they paid about $3.5 million way back in the day. And then a couple months later, there was a title company that was allegedly involved in a scheme for, mortgage and title kickback. So, it does happen according to the CFPB. We just don't know how frequent. My guess would be there are a number of companies that do similar work, I guess you could call it, engage in similar practices, but are probably a little bit better about hiding it or don't, maybe spend as much on it. Freedom is a huge mortgage company, and they have a budget to do that. That all being said, it's not like Freedom has done a tremendous amount of purchase business either. They've fallen pretty significantly over the last couple of years. So it could be possibly desperation that they know that they've been falling in the origination game and they need to get back up. And, the whole market is really centered right now around purchase business. So that's speculation. We don't know. These are just allegations at this point. They haven't been tried in a court of law. We don't know if Freedom and the other defendant is planning on appealing the case, but certainly it's something that I think the whole industry is going to be watching very closely.
We may have just gotten back from Gathering of Eagles, but we're not done with events for 2023 yet. This October, we're headed right back to Austin, Texas for HousingWire Annual, and we want to see you there. We've got a power-packed agenda with content such as our Women of Influence speakers, peak performer playbooks, CEO playbooks, and more to propel your company forward, as well as a bunch of networking events. Because this event is open to real estate executives, mortgage, title, and everyone in between, you really have the opportunity to network with people from all across the housing ecosystem. If you want to learn more about the event, or if you're already ready to get registered, head over to HousingWire.com on the events tab and you can learn all about it. Not to mention, if you're an HW Plus member, you're going to get 50% off your ticket. So get registered for HW Plus and get registered for the event so we can see you out in Austin.
Well, you had alluded to the idea that because it's been 6 years since a similar enforcement action was undertaken by the Bureau, that maybe this could mean that that the federal government is looking more closely at this kind of violation. What more do you think about that?
Yeah, I think that it's very likely that the CFPB under Rohit Chopra is going to be looking quite closely at real estate agreements. The whole industry, it's a big ecosystem, right? And everything is connected. So the mortgage lender is connected to the real estate brokerage. It's connected to the title insurance company. It's connected to the appraisal company, which often involves an appraisal management company. And in some states, it's connected to real estate attorneys. And, then there's a whole secondary market as well. These things don't happen in a vacuum. And because there are relationships that are referral based, right? It's built on this idea that, another third party is providing a service that will be of value to that client and they're getting the best service possible for the money that they pay. It leaves a lot of room for there to be potential bad actors. We know that the CFPB has looked very closely at a lot of these arrangements, broadly speaking. They've been looking at various marketplaces and exchanges. They've been looking at, the Zillow lawsuits that have been filed. They've been looking at all kinds of things related to real estate. We also know that the MBA and a lot of other industry stakeholders have complained pretty bitterly about the CFPB's, maybe I could say, like, practice in approaching this. It's not based on, hey, everybody, here's what I would like you to do. Do not do this, do not do that, do not do this. Instead, it's usually through enforcement action, similar to what we saw on Friday with Freedom. It's just, hey, here's the new plan, and this is the line, and if you step over it, you're going to get hit with a really big fine. And so the industry definitely does not appreciate that approach. And I think if you really want to look very closely at any kind of business that is, trillions of dollars a year, you're going to find certain relationships and certain practices that don't benefit the consumer. I think there's just too much money on the line. And the CFPB would probably tell you that when deals are much harder to come by, companies get more desperate, and there's a greater likelihood that there are going to be people who maybe towed the line previously and now are, several steps across it. So, like I said, we don't know the extent of this. It could just be an isolated case in which there's one lender who allegedly, paid for kickbacks and is going to get slapped pretty hard, and everyone else will fall in line. And if those practices are continuing on some level, then they run a massive risk. And just keep in mind, Chris, like, all of these companies have compliance attorneys. All of these companies spend a lot of money making sure that they don't get hit with a huge lawsuit or aren't embroiled in litigation that is unending. I mean, these cases can go on for many years, and it is very expensive to handle a case like that. So we'll see. I don't know, but it's certainly risky if there are other companies that are engaged in these practices and plan to continue them.
Yeah, and I think another potential wrinkle that could color this in the future is just that we know that a constitutionality decision regarding the CFPB's funding structure is pending in front of the U.S. Supreme Court.
Yeah.
And certain lower courts have demonstrated a little pause in terms of implementing CFPB enforcement actions pending that decision. So yeah, we'll definitely be keeping an eye on that, of course. Well, let's move on to the next story. We wanted to touch on the quarter-to-quarter loss levels for independent mortgage banks, or IMBs. What can you tell me about the numbers in Q2 that came out from the MBA?
Well, why don't we start with Q1? So Q1 was kind of a disaster, right? The average independent mortgage bank, retail only, by the way, lost almost $2,000 per loan in the first quarter of 2023. And all of those associated costs went way up. And that's partly because they hadn't cut enough staff to kind of hit the level in which the lack of volume really hurt them. And so what we saw in the second quarter is a lot of those cuts, which, generally, Chris, like, they take months to happen. These are, generally speaking, pretty large companies with thousands of employees. You cannot just walk into work on Monday and say, all right, we're going to cut 30% of our staff without a plan, without, the ability to stage some of the issues, without the ability to figure out who can step in. If you had, let's say, 10 processors and now you only have 4, which ones stay, which ones go? How do they liaise with, a loan officer or someone in underwriting? That there's a lot of strategy that has to go into making these kinds of decisions. And I think it also speaks to the challenges in just operating a mortgage company when rates are in the 6s, 7s, and in the second quarter, very much in the 7s. We've been in, I think, the 7% range for the last couple months now. And so that's going to show up in the Q3 data. But if you look at really the more, I think, minute points, so why don't we dive into some of the numbers on how some of these companies did. So the positive is about 58% of these retail mortgage companies were profitable in the second quarter. In the first quarter, only 32% of those companies were profitable. So that's a massive improvement. And production losses were a lot less severe than they were in previous quarters. And also keep in mind the servicing income was much stronger. And so, the majority of these companies did manage to squeeze out a profit in the second quarter. And the overall production volume for the average independent mortgage bank in Q2 was about 502 million. And that's up from 398 million in the first quarter. So volume was better. The volume count per IMB increased to about 1,550 loans in the second quarter. That's up from about 1,250 in the first quarter. But you look at production revenue, and it was only 328 basis points in the second quarter, and that's a decrease of about 30 basis points from Q1. And so that's where you start to get into really kind of the hairy monsters of the mortgage game right now. And so we're talking about fee income down, secondary marketing income down, warehouse spread has grown. It's a really, really difficult environment for them to operate in. And let's not lose sight of the bigger picture here, which is even though the loss was only 534 per loan, which was an improvement from the first quarter, it's still a loss, right? Like they were not doing great as originators. They have been basically saved by servicing. And I think servicing is going to continue to be a really strong business because it's really built around prepayment speeds, right? And who the heck is going to be refining, when rates are in the sevens and could be climbing closer to 8, right? Like the spread right now, I mean, it's been a couple hours since I looked, but it was like 4.35 this morning. I mean, that's crazy. We haven't seen a spread like that since, no joke, November of 2007. That's crazy. That is absolutely crazy. And so rates are going to be in the mid sevens today, probably around 7.5, maybe 7.6 potentially. And they're not going to be dropping measurably for a couple months at least. So when we talk about the third quarter, origination volume is not going to be much better than the second quarter. The second quarter is probably going to be a high, at least in terms of, origination volume productivity. So will servicing probably be about the same? I think so. It'll probably be pretty good. Is that enough for a lot of these companies to keep their heads above the water? I think so. Especially some of these companies are really, really smart in how they've managed their MSRs and how they've selectively sold when they had to free up cash. Others have been just bringing in a lot of income from, the servicing rights. They don't pay a lot, but, if you have hundreds of billions in servicing rights, you're going to bring in a fair amount of income. That's going to be, 50, 60, 70, 100 million per quarter or more, right? So there are positives, there are negatives. I think the third quarter is going to remain pretty challenged from an originations perspective, but we'll see if this ends up being sticky. It all depends on the Fed, right? It all depends on rates. And at this point, if I had a crystal ball, I wouldn't be doing this job. I'd be making money trading mortgage-backed securities or something.
There you go. Well, you had mentioned the increased levels of profitability, despite the fact that I think everybody is aware this is a very challenging operating environment, regardless of which kind of mortgage you're originating, as I'm actually currently writing about on RMD. But what do you think was a driver of this increased profitability? Obviously, it's not perfect, but you have to note an improvement when it happens. What do you think drove that?
Yeah, there's one very significant driver of kind of it's really on the expense side, Chris. So if you look at the loan production expenses, so this is how much goes into, all the costs associated with originating that loan. And those have been climbing like every quarter, I remember looking back at old data and it was like, hey, like, it reaches a new high of like $6,000 per loan in whatever month and year it was, or whatever quarter it was. And then you look at where it's been in more recent times and it's like, it's eye popping. It's absolutely crazy. So in the first quarter, we were looking at a figure of about hold on, here it is. Okay, it was $13,171 per loan in the first quarter. That was expenses. In the second quarter, that figure dropped to $11,044 per loan. And so it really comes down to they've cut a lot of people, the lenders. Many of those decisions really started to appear in the data for the second quarter. They were more efficient because their production volume went up a little bit and their expenses and costs went down a good bit. And some of these costs were, one-time fees related to severance or, healthcare payments that they have to make, or in some cases they've rewritten agreements with vendors. They've just cut a lot of costs, and that's out of necessity. That's not because these are, businesses that have finally figured out how to become hyper efficient in mortgage. It's just they cut a lot of people. They've rewritten a lot of agreements that they, used to spend a lot of money on. And they had a bit of an uptick because the second quarter is the traditional home buying season, right? People start in the spring and they really ramp up and they want to get it done in the summer before, the kids start going back to school or whatever happens in September. So that's kind of where I think we see the biggest change in the data. And we're going to see expenses, I think, probably drop again in the third quarter. So that's really where the intrigue will come from. When you have months of 7% mortgage rates, and geez, I don't even want to consider what it looks like at 7.6%, just as a a number to throw out there for a couple months. But that's going to chill the demand side, and you're going to see a pretty, relatively speaking, low level of volume. We've already seen that inventory new listings is down pretty significantly. So it was about 60,000 new listings last week. It was about 68,000 new listings a year ago that week, and about 80 something thousand the year before that in 2021. So, that there's no money to be made if there are no listings, right? And nobody's refining at 7.6%. It's like probably going to be 8% of the market in the third quarter, or maybe less. So it's all purchase. And if there are no listings, nobody's making money if there are no homes that transact, right? So third quarter is going to look pretty ugly, I think, on the origination side. But the benefit is I think they've really wrapped their arms around some of the expense issues. And we heard of two separate large non-publicly traded IMBs doing mass layoffs in just the last couple of weeks. So that, I don't know when exactly that data will show, maybe the fourth quarter, right? Maybe part of the third, but that's kind of where we are right now. So we do see continual changes to the expense side of the equation. And I think that's going to remain pretty sticky until rates really start to drop, right? And we're not going to see that most likely until, I almost hazard to make a guess because I had sort of assumed that they would drop by now, and they haven't. They've only, continued to climb. But I think conservatively, if you assume that the Fed is going to start cutting the rates, not just leaving them where they are, in second quarter of 2024, we probably won't see a 5% mortgage rate until maybe the end of 2024. We could be looking at a long time in the sixes. So that's going to really, I think, cause a lot of these lenders to say, if origination remains at such paltry levels, we're going to have to continue to cut to try to at least be even or a little bit profitable, because you just, how many businesses in any industry are able to maintain a strong business if you've lost money 12 quarters in a row, So
yeah, definitely. It's going to be really interesting to see if they are more aggressively trying to cut costs while this more challenging environment is going on, and if rates continue to trend upward, then it'll be fascinating for people like us to watch how things unfold, but it'll also certainly be an eventful time for the professionals who are, of course, on the front lines.
Yep.
So I think that point is very well taken. But well, great, James. Thank you very much for being a part of this. Really appreciate the check-in, of course, and we'll be sure to check in with you again on the top stories of the newsroom very soon.